All right, hello everybody. Welcome to week 5 in which we talk about the income statement. So in the last week we talked about balance sheet. Now we continue with the next important financial statement. Well, first of all, it's important that you understand the concept of revenue, expenses and profit. Then we look at the layout and further terminology, the link between balance sheet and income statement, and then we calculate depreciation, which is also a very important topic. Let's start recapitulation of last week. We see we have the 3 statements. We see we have the balance sheet, which is about the total wealth of a business. We have the income statement looking at how much wealth was generated and how it was generated over time. And then next week we look at the cash flow statement, which essentially looks at which cash movements took place in the company, inflows and outflows. And in the end, this all tells us something about how healthy the business actually is. So let's look at an income statement from Tesla. For the year ended 31st of December 2017. We have 3 parts. We have the revenues, the blue part over here, which is all the inflow of economic benefits. So for Tesla, this is the automotive sales, leasing, energy generation and storage, and so on. Then we look further at costs and expenses, which is the outflow, so the opposite. The outflow of economic benefits, so they had certain costs. Also regarding the sales of cars, research development, and so on. And finally, we have revenue minus expenses. So this minus this gives us profit or loss. And this is something you can see here. They split it up according to several classifications of losses or profits. So loss from operations, loss from income before income tax, net loss, and so on. So of course you see here it's a loss rather than a profit, but usually then it's just called operating profit, net profit, and so on. And that basically is everything that is important from the income statement of Tesla. And well, of course you see here is a loss, but we can't say from that that the company is not doing fine, because they might also have, let's say, extremely high costs for research and development, or for certain other things, and then in the future this might lead to so much more increased sales. So we would have to take a way more deeper look at the company to actually classify, to say if the company is doing good or bad. And also for next week's cash flow statement, this is also going to be an important indicator how good a company is actually doing. So let's look further. Examples of revenues. First of all, as said, it's the inflow of economic benefits, and if you sell goods, this is the main source of revenues. When you sell a service, so let's say you as a student, you buy the service of education from Fontes. So that's fees for service, fees for subscriptions. So if you have Netflix, you know what I mean. On a monthly basis, you have to pay something. This is income for the company. Or finally, also, if you put money on the bank, you receive interest in return. And this basically then is also a form of income. Well, examples of costs or expenses. Well, first of all, it's the outflow of economic benefits, and there are numerous examples. And this is just some ideas that you might want to have. Cost of goods sold, that's a very important one. And you saw that also with the Tesla example. They called it something like the costs of the revenues that they created. And of course, when you sell goods or services, you also have costs attached to that. If you sell a chair or a table, you also had the raw materials that you had to buy, and those are directly matched with the income that you get. So if you sell a chair for 100 euros, but you had 50 euros in costs for getting the raw materials, you directly put those together. That's called the matching principle. Because you should match income with expenses. So if you had income from certain things, you also have to match the corresponding expenses. And that's called COGS, or cost of goods sold, cost of sales, or any other classification. But the idea behind that is always the same, that you match the costs with the revenues. Salaries and wages. Well, salaries is a fixed salary a person gets for the amount of work that the person is doing, and wages means the person is actually receiving money based on the amount of hours that the person is paid. Rent of a shop that you operate. Motor vehicle running costs like fuel, maintenance, and so on. Insurance, you might want to have an insurance as a company for certain things. You also have to pay that. And then one more important thing is depreciation. If you all look at your phones, and you probably, if you take out your phones, you see, well, it had a certain value. So let's say you bought it for 500 euros. But over time, the value decreases. The same also goes for your car, for your for furniture you have at home. So non-current assets actually depreciate and lose value over time. And that's, of course, something you have to put into consideration. Take into consideration, because if something loses value, you have to classify that as an expense. So, but we'll come to that later at the end of the second part of the lecture. Heat and light of your offices might be another form of expense, telephone costs and whatever. So that's just a first idea for you what costs could be. So, layout and terminology of the income statement. Well, we see the first part, as I said before, you always start with the sales revenue, so the inflows of money that you have, and then you match this revenue with the costs. And the cost of sales, cost of goods sold, are the cost of the goods sold during the period. An example of that I gave you before. So sales revenue minus the cost of goods sold gives us the gross profit. And this is simply the profit from buying and selling the goods. So revenue minus the cost of goods sold. And then we subtract basically all the other expenses that we have. So you can see operating, and this leads us then, if you subtract everything, to the operating profit, which is simply taking the gross profit minus all the operating expenses. And operating expenses means simply those expenses you have when operating your business. And this leads you to the operating profit. And then finally, you might have certain interest received, or you have to pay interest on borrowings. You add or subtract this, and then you get to the net profit for the year, or profit for the year, which is then the bottom line. So of course, if you don't have these things, you can directly go to the net profit. But this is the general layout. As seen, profit for the year, also called net profit, is the amount attributable to the owner. So this is added to equity, because as said also before or last week, owner's equity is changed by the amount of profit or loss that you make. So operating profit plus any non-operating income like interest, and minus non-operating expenses, like if you have to pay interest, this leads to the profit for the year. So let's look at the link between the balance sheet and the income statement. Well, we have the assets, liabilities, and equity. So assets equals liabilities plus equity is the balance sheet equation. On the other hand, we now learned profit or loss is revenue minus expenses. Important thing is, profit or loss changes the wealth of a business, changes the equity. So basically, if we have the balance sheet on the one side, we have the income statement on the other side, well, we can see that this part, the net profit, actually has an impact on the equity. And this is called retained earnings. You keep the earnings of a particular period. So basically, the net profit comes into equity. And that's why you can actually combine the two formulas and then get another formula out of it that you can then also use also in the homework task when we look at the different effects of transactions. It always should be in balance. So also not only the balance sheet equation needs to balance, but basically the whole system balances. So you see then, if we take it together, we would have assets equals liabilities plus equity plus profit, or plus revenues minus expenses. And then this is the new equation that we use. And in the end, this makes it easier for you to classify where things are happening actually. And that is the connection between balance sheet and income statement. So let's look at depreciation now. Depreciation, as said before, most non-current assets do not exist forever. They have limited life, so a smartphone is used up after 5 years, you buy a new one. Non-current assets, as said before, they lose value, they depreciate. That's called depreciation. You see the car or the motor vehicle is depreciated half, and then let's say after 2 or 3 years more, you have to get a new one. The total depreciation on an asset is called accumulated depreciation. So basically every year an asset depreciates, and then if you take this all together, it's called accumulated depreciation. So if you have your phone now for, let's say you buy a new phone, you have it for 1 year, let's say it depreciates 100 euros. Then you have it another year, it depreciates also 100 euros. So what is the accumulated depreciation? It's 200 euros. So it's 2 times 100 euros. And if you take the cost of the asset, let's say 500 euro for the smartphone, minus accumulated depreciation, which we just calculated as 200 euros, equals what the asset is worth now. And this is called net book value. So what is the net book value of your phone? It would be 300 euros. And finally, for intangible assets, the term amortization is used and not depreciation. So intangible assets being patents or other parts of intellectual property. So then the question is, how do we calculate depreciation? And that's also quite easy. The first thing we need is the cost, also called fair value of the asset. Regarding the smartphone, it was 500 euros. So that's the cost of the asset. Then we look at the useful life. So how many years do you use it? For a smartphone, let's say 4 or 5 years. That's something is also important we need to have for the calculation. What the value at the end is, so when we actually want to sell it, it might have still a certain amount of value. Let's say when you have a smartphone for 5 years, you might still be able to sell it for 50 euros to a friend or to somebody else. This is called residual value of the asset. And then finally, there are 2 ways of depreciating assets. And the first one is the straight line method, which is easier. And we also have the reducing balance method. So let's start with the straight line method. This is the easier one. And this actually means that you have an equal depreciation expense every single year. So basically the calculation we have to do is we take the cost of the asset, we subtract the residual value and divide the whole thing by the useful life. So it's a very easy calculation actually. And it looks like this, that every year the net book value, so the value of the asset is going down by the same amount. So let's take an example. Let's take an example of a straight line method. Let's say we have a cost of machine 38,124. The useful, residual value, of course, this is an estimated amount because you can't really know what the exact amount is, but there are certain tables that help you with that, and also you can estimate how much it might be worth. 4 years useful life estimated, and now the question is, what is the yearly depreciation? So put it in a formula and try to come up with the solution yourself. Well, when we calculate it, it's 78,124 minus 2,000 divided by 4 is 19,031. So let's look at what happens in the income statement and balance sheet with this, because an annual depreciation, this part here, is actually a cost. So something that the company is expensing. So it's a value that is lost, and therefore we have to put it in the income statement. Let's have a look at how this actually works. So let's assume that we have the asset, or the company bought the asset end of December 2015. Now it's the end of December 2017. So it's 2 years that we actually own this machine. So what happens in the income statement? As said before, it's an expense. Income statement for the year ended 31st of December. The extract, the most important thing of that income statement is that the annual depreciation of 19,031 is shown as an operating expense. Because we lose value in the asset, so we have to show it as well in the income statement. What happens in the balance sheet? Well, we have an asset. The asset was worth 78,124. But after 2 years, of course, we have 2 times the depreciation. So 2 times the 19,031, which gives us 38,062. If we subtract that, we get to 40,062, which is the new value of the asset after 2 years. Let's now look at the reducing balance method, which is a bit more complicated. It actually means that you have a fixed percentage of depreciation, which is applied to the net book value. So at the beginning, you have a higher depreciation, and then it slows down a little bit. So it looks like this. You have more depreciation at the beginning, and then less. And basically, the net book value goes down at the beginning quite quickly. The formula for this is this. Don't worry, it's not too complicated. So the percentage is actually 1 minus the number of years. And then you take the root of the residual value divided by the cost of the asset. And if you put that in a calculator, it might make sense to put a bracket around the R divided by C, because otherwise some strange and crazy things might happen with the calculator. You multiply this all with 100%, and then you get to your amount of depreciation every year, or your percentage. Let's take also an example for that. The same example as before. And now the question to you is, what is the depreciation percentage? If we take it into calculator and add the cost, residual value, and the useful life, just put it into the formula that I showed you on the last slide, we actually get to 60% or 59.99 something. So we round it to 60%. And now we can actually make the same task as before, or let's say not the same, but we can calculate the yearly depreciation, because actually it's not the same depreciation every year. So we have to calculate what it is every year. We paid 78,124. And at the end we want to have 2,000 here, because that's the residual value. So 60% of the cost is the first amount of depreciation. So simply multiply this with 60%, giving us 46,874. So the net book value is the cost minus the depreciation. So in this case, we have this minus this, gives us the net book value of 31,250. So after the first year, the asset is still worth 31,250. And now we can go on like this. So 60% of this gives us the depreciation for the second year, because it's always 60% of what the asset was worth, so of the net book value. So this is 18,750. And if we take the net book value minus the new depreciation, we actually get to the net book value after 2 years, which is 12,500. We go on like this. Third year is 7,500, net book value is 5,000. Year 4, depreciation is 3,000, and then we get to 2,000 finally, which is the residual value that you can see also over there. So it's simply 60% always of the net book value. So let's also look at what happens in the income statement and in the balance sheet. Let's assume again we bought the machine 2015, end of 2015, now it's end of 2017. So income statement for the year, actually we have the annual depreciation. And well, since it's different every year, we have to look at the second year. And the second year we had a depreciation of 18,750, which is the expense that is shown in the income statement for this particular year. If we look at the balance sheet, what actually happens is that we have the machine at cost, which was 78,124. Then now we have 2 years of depreciation. It's not this multiplied with 2, because the first year's depreciation was different. And what we simply do is we take the first year's depreciation and we add the second year's depreciation together, and this is of course the accumulated depreciation. And then we have the net book value of 12,500, which you could also see before. When you look at the table, we had the net book value after 2 years, 12,500. So it's basically the same as on the slide before. So how do we choose? The choice of method depends on the economic benefits, when the economic benefits of the asset are received. So if you buy an asset and every year this asset, let's say, brings us the same amount of revenue, we take the straight line method. And if we have, so it's then basically like this, so revenues or the benefits are the same, we take the straight line method. But if, let's say, an asset is, let's say, quite good at the beginning, helps us a lot at the beginning, but then over time becomes less and less important because it gets old or something like that. So the benefits go like this, or we get them like this. Then we use the reducing balance method because the benefits are also declining over time, and we have to match the benefits with the outflows in this case. So homework. I've got 2 homework tasks for you. The first one deals with depreciation. This task is quite easy, so please have a look at this and solve this at home. And then we have another one which is, I would say, quite difficult and quite long. So it's called TT & Co. It's also based like the last one on the book. And so you have the balance sheet given of 2009, so end of 2009, and you have given what happens during 2010. So basically what you should do is create a new income statement, or an income statement for 2010 and a balance sheet for 2010. So this is 2009, so we should create this for 2010. And then basically this helps you, together with the old balance sheet, to create the income statement and balance sheet for 2010. Well, finally, we also like you to read. We like you to read cost of sales, recognizing revenue, recognizing expenses, and trade receivables problems. And like I also said before, we will not check these things in the tutorial, but we expect you to know them, because then we can build up on those ideas and incorporate them in homework tasks and in the lecture. And also, we might ask you about these things in the exam. So we might ask you detailed questions on when revenue is recognized, when expenses are recognized, and bad debts, and so on. So please read the chapters carefully, then you will also better understand the ideas of the homework. So this is the pages that we used, 72 to 82, 89 to 97. So if you can read that again if you didn't understand something in detail. Thanks very much, and have a good day further.